So good morning, everyone. I want to welcome you to episode 20 of In Conversation with Convergence. I am George Evans, one of the founders of Convergence, and as many of you know, we're celebrating our 10-year anniversary this year. We tend to have a monthly podcast. We meet with a variety of industry experts, and we discuss a variety of topics and trends. And today I have two very distinguished guests, and one might say luminaries, joining me, and I'm very excited about these guys being with me on the Convergence podcast. First is Ron Geffner, and for those of you who are in the industry, you probably know Ron, partner at Sadis Goldberg. I read Ron 25 years, so congratulations. But Ron, his reputation is clearly he's an expert on private investment vehicles, on the regulatory environment, and Ron and his firm provide fairly extensive legal services to the alternative investor community. My second guest, I probably don't have to introduce my second guest, but that's John D'Agostino, and John is the CEO and founder of Dagger Consulting, and Dagger is a strategic consulting and advisory firm. John's also a senior advisor to Coinbase. And John is also chairman of the U.S. Asset Management Committee for the Department of International Trade. So welcome, Ron. Welcome, John. Thank you both for making the time to join me today.
Thank you for having us both on.
Thanks, George.
Yeah, thank you. So listen, why don't I kind of gave a macro snippet, but I'd love to hear you guys just kick it off with just a little introduction about your firm and yourself that builds a little bit on what I said, and then we'll kind of get right into some of the topics our listeners wanted to talk about today. So maybe, Ron, we'll start with you.
Sure. Appreciate the opportunity. Hi, everybody. My name's Ron Geffner. I'm a partner with Sadis Goldberg. I founded Sadis 26 years ago. I started my career at the SEC prosecuting asset managers in New York. In that time, our firm has founded over 1,000 hedge fund, private equity fund, venture capital fund, real estate funds. Our clients are located globally. Various databases rank us on average number 3 in the United States and 7 in the world in representing hedge funds. And I'm fortunate to be in the industry that we are in.
Yeah, thanks. John?
Yeah, George, it's great to be here. It's wonderful to see how your business has grown and the podcast has grown. So thanks for having us. John D'Agostino, as you pointed out, I run a small consultancy. Fortunate enough to be a senior advisor at Coinbase Institutional, the cryptocurrency exchange. I maintain a small portfolio of boards of directors where I sit on the boards of directors of very high quality hedge funds, both in the traditional asset management space and the cryptocurrency space. And then in my spare time, I try to do some interesting things like chair the DIT, Department of International Trade, which is a arm of the UK consulate or an arm of the UK government that helps U.S. financial services institutions like hedge funds establish themselves in the UK. I'd love to say that there's some grand design behind that, but honestly, I spoke on a panel with a really interesting guy about 10 years ago and just kind of fell ass backwards into it. I've always had this theory. When I graduated from business school, everybody was like, what defines success? And it was mostly money at Harvard. And my theory was always whoever dies with the most stories wins. So that's my goal, is to collect some interesting stories, and hanging out with the Brits has been continuously fascinating over the last 10 years.
Now, John, didn't I also just see you speak at a conference or a panel over maybe in the Middle East recently?
I've been around a lot, George. To be honest, I'm probably overexposed, which is so. I'm going to take a break after this. You're the last one I'm going to do for a little bit. Yeah, look, historically I've spent a lot of time in the Middle East. Back in my old NYMEX day, I was head of strategy for the NYMEX. I was really, really honored to be part of the building of the first Middle Eastern derivatives exchange out in Dubai. Now, that sounds kind of boring, but the notion of using a Western capitalist principle like open market exchanges to price crude oil, at least back then, was kind of cool. Yeah. And it was a great example of what happens when we work with other countries and export elements, principal elements like capitalism. Like it was a wonderful experience, and I head back there every couple of months.
Yeah, well, thanks. Well, listen, let's get into some of the subject matter, right? And one of the things we do is talk to our clients, talk to our prospects about the things they want to hear, right, and want some experts in the industry to talk to. Let me kind of talk about the elephant in the room, right? And I'll just call it the financial markets, right now, right? It's painful to watch this every day, although it's been fun to watch it the last 3 days, right? But when you think about the financial markets and really, Jamie Dimon comes out and says, I wouldn't be surprised if stocks went down another 20%, although his stock's gone up to about 122 from about 106 in the last 3 days. I'm interested in your guys' take. Maybe we'll start with you, Ron. Kind of where are you bullish? Do you think things are leveling out? Do you think we're on the cusp of a recession? Do you think we're going to continue to see this roller coaster, or are you expecting another downturn? And listen, we'd all be retired if we really knew, right? So I get that, but kind of interested in your thoughts. So let's start with you, Ron.
Sure. So first and foremost, I realize I don't think I can ever call the markets, and I'm not in a position of market time as an investor. So I view it as a long-term horizon. I'm not trading anybody else's money. I'm only investing my own or my family's assets. So my time horizon isn't 3 months, 6 months, a year, 2 years, 5 years. It's far longer out. Second, one of the things I've been picking up the last several months is a general anxiety, not just within the asset management community, but the population as a whole. We've gone through a long, the largest bull market in history. People have seen their portfolios increase. So if you go out on the street, it's a common concern among everybody right now.
Right.
So, and why? Because when you're at the top, you pretty much feel like the only place you have to go is down. Now looking at professionally my experience, somewhere mid-August to somewhere mid-September, phone got quieter. Some managers were calling us up to create additional products to existing products, but it got quieter in general. And historically, since founding Sadis, my phone's never stopped ringing. It's an average day is literally frenetic. Starts at 8 a.m., literally ends at 11 p.m. And I might have had a week of a year where busy was a slow week for me.
Yeah.
I would say now in about the last 3 weeks, I'm seeing a lot of activity globally. People calling us up from various financial centers in Europe, people calling us from all over the United States, and I'm not seeing one flavor. So if I went back in my career for the last 15, 20 years, things usually came in like 3s or 4s or 5s. Things were pervasive. There used to be like clean energy, or cannabis, or crypto, or long-short equity, or distressed, depending on what the flavor was at that time. Somewhere in the last year plus, I really have not seen a consistent flavor in the market. I have somebody launching a short fund currently. We have people launching global macro products, people launching long-short equity. So to me, this is a leading indicator, not a lagging indicator of where I think it's going to go. And while people are hyper-focused now on a recession and inflation, and while I think they are there, I can't tell the severity or the timing of it. But to me, I'm a contrarian. When, pardon my language, when the world goes to poop, I view it as an opportunity. And so to me, right now I'm stockpiling some of my cash, looking forward to some of the changes because I'm not at my retirement age. So
right.
My investment horizon's much longer term.
Yeah, no, and I think kind of talking about it as an opportunity is a view a lot of people have. And I think people probably had an unrealistic view given the last 2 or 3 years of growth, right? To your point about watching all of our 401ks grow, for example, the way they did, right? And this year's been very humbling, right, for a lot of people. John, what's your view on the markets?
So I remember after 9/11, my father was in Two World Trade, and he made it out alive, barely, and he was hospitalized. The firemen had to carry him across the Brooklyn Bridge. So I didn't know. I was in business school. I didn't know he was alive for about a week. And as soon as I could get back to New York, it took about 3 weeks before you could get back to New York. I flew in, and I took the train in. And after I saw him in the hospital, the first thing I did, I was graduating business school the next year, and I went and looked for an apartment. and this was 10 days after 9/11. And I remember everyone saying that was crazy, right? There was New York was dead. New York, it's over. Why would anyone ever live in New York ever again? And every apartment value is going to zero, and just getting one was almost impossible because you couldn't get a mortgage. Try getting a mortgage, right after that. And I found a place on Fifth Avenue. I got it. I bought it all cash. And if I would have had the guts to buy 10 of them, I'd be retired right now.
Yeah.
So the pessimists have the mic right now. The bulls had the mic for 15 years, and the bulls were, especially towards the latter end, especially in certain asset classes, were obnoxious about it, right? So linear interpolation is a wonderful thing, right? You take a data trend over a small period of time, you straight fit a line through it, and it looks incredible. It's going to go up forever. It works the other way too. And
Right.
Guess what? The pessimists have the mic right now, and they're using the same methodology, the same mechanisms. The pessimists have the mic now, and they use the same basic mechanisms to linear interpolate, the world going to zero. And so, to Ron's point earlier, if that's the case, then who the pessimists I listen to are the doomsday preppers, because at least they're consistent. Right? Because if you really believe that we're going to zero and society is going to disrupt and we're going to have massive inflation and the ocean's going to take over the Midwest, if you believe all that, then you should telling me to buy treasuries, tips, gold, Bitcoin, that's irrelevant. You should be buying guns, seeds, and barbed wire. Because if I have a gun and you have Bitcoin, I'm getting your keys from you. So I don't believe that's where we're headed. No, look, there are serious climate change issues. Inflation is real. Fed policy is problematic. I'm not suggesting these aren't all real issues. But if you're in the camp of we will probably cycle out of this in some way over time, then to Ron's point, the best, and I'm not, don't take investment advice from me, but the best investors I've heard, I have the luxury of sitting on these boards and working with firms like Coinbase that I get to hear what the best investors are doing. The smartest ones are stockpiling cash. As we've learned over the last couple of years, there really is no good inflation hedge. Right? There just isn't, right? However, if you listen to the Paul Tudor Jones of the world, who publicly has said the best inflation hedges are these sort of baskets of physical commodities as well as things like Bitcoin, and then also having cash and sort of dollar cost averaging into strong economies that will survive these cycles, like the U.S. economy, then you're usually okay. Now, your timing could be off, and you could hit a 20-year cycle where it's really bad. But I guess call me a naive optimist. I think that we will be. I don't think Ron and I will be on a Mad Max type vehicle scrounging around the earth for oil. And you know what, George? If it gets to that point, I don't want to live. I got to be honest. I'm fine with not prepping because I'm a soft city boy. I'm not going to survive. I'm not going to survive Mad Max.
Now, listen. I think two things you guys said, right? I think, Ron, to your point, I believe it's an opportunity, and John, I believe we will cycle out of it. And I just think when you say the pessimists have the microphone, it's very amplified also right now, right? It's louder than it's ever been, and I think we'll cycle out of it. That brings me to let's talk about alternative investing, right? And everything I look at, people can kind of get hot and cold on it, right? Pension plans decrease, increased allocations all the time. But, when we look at the numbers, right, assets are continuing to grow. When I look at fund growth, right, it's while even cash into hedge funds is increasing, it's going into a lot of existing funds. But the real growth in terms of new funds is obviously closed end, right? We're seeing so much PE and VC and real estate and structured asset funds right now, and so much dry powder, right, on say the PE front. So curious what you guys think about alternative investing right now, and kind of where that is a little bit in people's minds, and kind of the curve. Are people taking a step back because of the risk that's always different and associated with alternatives? What's your view, Ron, on alternative investing? I personally think it's probably stronger than ever, and will continue to be.
So great question. There's obviously not any right answer to the question. If you're really analyzing, I think going back to something the three of us have touched on, let's look at the time horizon of what we're discussing. There's been an increase in closed down or private equity fund structure since 2008 when the markets crapped out and people wanted to have a non-correlated return. Private equity has had a long run, but pre-2008, hedge funds were fairly strong and fairly popular, and there were people engaging in strategies that were private equity-like and structuring them in hedge funds, and there was a mismatch or non-correlation between the liquidity features of the documents and the portfolio construction. So when we start to talk about structures as a whole, I often look past the structure and I would look to the manager. You're investing with a person, you're not investing with a company, in my mind. So in other words, who's calling the shots? Is it an individual or an investment committee? But I think that's really the core to the question. Then you look to see what that group or person is offering, and hopefully you have some sense of or ability to understand and analyze it effectively, because not every structure is done correctly to the strategy.
Right.
And then it's also style drift. So it's not also looking at the manager for that day, but really getting a sense of what do you expect from that manager to perform. So if this is a portfolio of a range of managers, do you want each one to cover a limited range of portfolio? Meaning, are you looking, if it's liquid securities, large cap, mid cap, small cap, you don't want them to all correlate to the same portfolio. Same thing with private equity. Private equity tends to not style drift as much from what I know than hedge funds. But I don't personally feel biased towards one versus the other, because I think it's a blend, and I want some form of diversification while avoiding over diversification.
Yeah.
And I go with my own instinct on where I think things are going. Personally, like I've been VC direct investing in cannabis now for 9 years. I was fortunate enough to invest in a few companies that went public that have done well. I didn't position size well, but I have my own fundamental belief of my life and what I see and where I think things are going. And I think everybody has that belief. They just don't feel validated in really strongly in their own belief because they don't feel they have the experience. But the reality is, open your eyes. You can see where you're spending your money. You can see where your friends are spending their money. You can see what keeps them up at night. Like with regard to mortgages and interest rates going up, it's maybe a really good time to invest with banks.
Right.
Banks have gone through a recapitalization post-2008. I hopefully imagine there's less leverage in the system than there was in 2008. Interest rates are going up. What about the brokerage firms that also have prime brokerage and trading that make money on Saturdays and Sundays through margin indebtedness? So just look at your own life. Like if you're looking at cars or houses or hot tubs or lumber, everybody has an opinion. Then find somebody who
you can tell Ron's building a house.
No, Ron.
He goes straight to those examples.
Yeah,
Very
listen,
relatable, Ron. Very relatable.
I just went through the cost of lumber, right? The last year, right?
For those of you pricing hot tubs, Ron, it's yeah.
Exactly. But the point is, like in other words, I think we also live in a society where we often feel as victims, or we also feel not in control of our destiny.
Right.
And the reality is, you're only a victim if you think of yourself as a victim and you allow yourself to be a victim. And I know that sounds like an extreme response to the question, but the reality is you can't be lazy with your money. If you're going to be lazy and not invested, you might as well, you're gambling. If you're just throwing money without the diligence and without active ongoing diligence, and I'm not saying I'm on top of it myself with everything in my portfolio, but I at least understand it's still my responsibility to look at my returns. Like we talk about the market. How many people have said to each of you, you know what, I don't want to look at my 401k because I know it's down. I look at my portfolio all the time.
Right.
And you know what? It's okay for me to sit there and look at the pain and say, yeah, I am down, but guess what? I still have to deal with it. I can't put my head in the sand. So when it comes to managers, it's the same thing. And like whether it's whether it's a hedge fund manager, private equity fund manager, or your wealth manager, and you're going to one of the big wirehouses, it is amazing that people set it and forget it.
Yep, agreed with you. John, what's your view on the
Yeah, I agree with Ron. Ron's right. The only adjustment I'd make, or the only thing I think you have to think about is you got to do your own research, of course. And Ron's correct. If you leave these decisions stagnant, I would hope that you have, and again, it's a very privileged position because to have enough money to get professional help is a privilege. But let's assume you're in a position where you have enough capital to have someone looking after it, whether even if it's a robo-advisory. I agree. Just like with your medical life, right? You can't just be benign. You can't just be laid back. You have to ask questions. You have to. That being said, I am also a big fan of trusting experts. And so I go back and forth with the kind of fully agreeing with what Ron's saying, and then maybe think, but then there's also this danger. We've had this do your own research danger that has spilled over into so many elements of society. If I'm going to go to court, if I'm getting sued, if I have an SEC investigation, I'm trusting Ron. Now, that doesn't mean I'm blindly listening to what he has to say, but I'm going to acknowledge his level of experience, right? Your Google search is not his law degree.
Right.
And so I think we have to, you should be active, you should be informed. I'll give you an example. I volunteer for St. Jude Children's Research Hospital, and you see families that come in, and their kid gets diagnosed with the worst possible thing, and you see families where the parents did not have a high school education, and in 6 weeks, they are doctors, effectively. Like the amount of research, the amount they learn when it's their child is just extraordinary. But they're not doctors at the end of the day, right? They've become incredibly well informed, but you can never substitute those years of experience, trial and error. So I get sued, I'm shutting up and listening to Ron. And I think you do your own research. You think about these decisions. You engage with your professional. But I do think people have to understand how difficult and the tremendous amount of work it takes to keep up with market movements. And you've got to trust. You have to trust your advisors.
But Tom,
and maybe
I'm not saying
sorry, go ahead.
Trust. Sorry to interrupt, but I'm saying trust but validate. That's all
Yes.
I'm saying. Trust
There
but
you go.
validate. Don't be asleep at the switch. And no one's perfect. We all make mistakes, including the professionals. But if you don't validate and you're a finger pointer, then quite frankly, look in the mirror because you're the one who's responsible and culpable.
And to a point,
I agree.
John.
Ron and I were talking about this before on the call. Like when I I'm not that old, but like I remember 15 years ago, I used to get asked to be on CNBC a lot because I was head of strategy for the NYMEX.
Yeah.
And it was like looked down on. It was like people who were on CNBC. It was like, well, if you're not a real guy.
Right.
You're not.
Well,
total 180.
Right, you're a Republican if you watch Fox, and you're a Democrat if you watch CNN, right? I mean.
Oh, I'm sorry. I meant just the idea that a financial professional would be on social media or TV. Back then was kind of like, you're not a serious person, right? Obviously, there's done a whole 180. Right now, it's completely different. It's hard to build a career without building a brand. And I'm not saying that's bad. I think it's good to have information out there, but there's pressure. I mean, so like I would ask Ron, like as a lawyer, right? There's so many rules about what you can say and not say. How do you relate the need to be out there with those rules? And do you feel pressure sometimes to say outrageous things or take extreme positions because that's what gets you a bigger brand?
Press. Yeah, gets your
versus,
notice.
let's face it, the truth is often nuanced.
Yep. So, Ron, can you hear us okay now, me especially?
Yeah, I can hear you well.
All right, well, while you were gone, we said two things. We hope you weren't wearing matching pants, right? That was one thing. And then, and then secondly, we really thought behind it you would have a bigger plaque than that little thing.
Yeah, that's what the government gives you when you're at the SEC.
All right.
Is that the SEC participation trophy, Ron?
All right. All right, here we go. So we're gonna let's go. I want to go to a couple hot topics now, fellas, in the industry, right? So let's start with ESG, right? And then I want to talk a little bit about digital, right? Ron, your view. Let's start with you. Your views on ESG these days.
So I'm going to give a shout out to my friend Joe Holman, who's at Witham, who I just had breakfast with before this podcast. Joe's filling me in that the accounting industry has adopted standards in connection with ESG, which is brilliant for the accountants because it gives them one more thing that they're now going to be further involved with. He was telling me institutional money looks at ESG. I had just hosted an event personally with about 63 professionals from all over the world, with auditors, administrators, prime brokers, lawyers tied to the private fund industry. A friend of mine from the family office side had indicated family offices really don't look at it. I think it's still very early days. I
Yep.
don't know necessarily where it's going to go from an investment standpoint in the timing, but the global climate is important to all of us, and the younger generation feels it's going to be left to them even more so. So I have to imagine it's only going to become more important.
Yeah. John, your view?
Yeah, and that we talked about this when Ron was off, George. Bemoaning the politicization and partisanship, even in things like finance. Like ESG is a great example, right? It's back up 10,000 feet. No one is not worried about this stuff, right? Unless you're completely blind, right? It's not. It is real. We can debate on the fringes, but the notion of doing things better for the planet, the notion that more women should be integrated into senior level, like this is all common sense. I don't know anyone who disagrees with those basic premises, right? Then we start disagreeing about the costs associated with it and blah 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 blah. But the notion that there's a backlash against ESG is just very, very silly. There is one. I mean, and so I think, and I'll blame both sides. Part of it was, proponents of ESG and the way it's currently envisioned were kind of ramming it down people's throats. On the other side, you have kind of delusional denialists. But I think ESG is here to stay in the sense of smart institutional allocators are thinking about these very, very real climate, fiduciary, social issues. They will impact value. Companies in industries that intelligently factor them into their business models will do better, so that they're part of a good investment thesis, and they're also the good, right, moral thing to do. I'll make an outrageous claim right now. It is good to want more inclusion. It is good to want the world to be cleaner. When I walk into a hotel in Europe, you have to put your key card into the thing to put the lights on. That's just smart. There's no reason why you should forget that way. You'd never forget to leave the lights on. You always have to take your key with you. Yeah. There's no reason why we shouldn't put solar panels wherever we can. Again, assuming lots of variables. But so we just need to step back from this. I think ESG will be truly successful when we don't call it ESG anymore. When it's just integrated into everything that we do.
But one of the problems, John and George, is the government's still playing catch up on coming up with protocols in the financial services industry.
Yes. Lack of clarity, sure.
And that's happening there and in the cryptocurrency industry and a range of other sectors, I'd say cannabis as well.
Yep.
And as a former government employee, I understand the why, right? The government's there to really make sure that people don't get hurt.
Yep.
But they're all, and by importing or creating standards, there is an effect it has on industry as well. So while we get frustrated as a population, we feel it's not getting the right attention. Taking the wrong misstep and over-regulating could have as easily a detrimental effect as it is like raising interest rates on the effect on the market.
I agree.
Yeah, I mean, listen, one thing we're doing, and then we'll move off ESG, is you may be aware, we risk rate the middle and the back offices of all 20,000 SEC registered advisors, and we look for high-risk business conditions, and we actually look for business conditions that correlate to SEC infractions, right, early. We say, hey, this advisor is starting to look like somebody who was just fined $100 million by the SEC. But one of the things we've done is an ESG score, right? The allocators have asked us to start to at least try to come up with a standard way to measure, which is not easy, and it'll continue to be enhanced and tweaked, but a standard way to measure kind of the advisor and their ESG, prowess and thesis, and we're trying hard to get some feedback on that right now. So it's an interesting time. I agree with what both of you said. Let me move to another topic, and I think we're going to have to probably keep our comments to a couple minutes on this, because at this one you could talk for a whole podcast on it, and that's digital, right? And I'm going to start with you, John, because of Coinbase. But so listen, here's what I see, right? In its infancy, it's still, I think it's here to stay. I think there's still a lot of people on the sidelines building infrastructure, getting ready, and maybe put their toe in the water. And I'm talking the big ecosystem, right? All the service providers, all the allocators. But I think it's here to stay. I think people are getting ready. I think people are building infrastructure. Curious what you guys think about, digital in the market today.
Yeah, certainly here to stay. In what form it will take, I'm not sure. But again, the narrative has been hijacked by the extremes, right? You've got individuals who get up and scream, we're not going to have a U.S. dollar in 5 years, which is nonsense. And you have individuals who get up and scream, all this stuff is worthless, which is what exactly people said when we went off the gold standard of Bretton Woods. So, it's the reality is again nuanced, right? So let's take one thing as an example. And George, you and I were talking about this before the call started. So NFTs and digital art.
Yeah.
Is it ridiculous that people were spending $13 million or more for a JPEG of an ape? Probably. Yeah, that's probably kind of silly. Is it insane to think that in some period of time, when you go to an art collector's home, just like the art that person collects now is different from what the art an art collector would collect 100 years ago? Is it insane that you would see beautiful sculptures and Monet paintings and then embedded in there a beautiful LED screen showing a really fascinating piece of digital art? To me, it's ridiculous to think that's not going to happen, right? The idea that we're going to have exactly the same art that we have today that we'll have in 25, 50 years. So I think they'll...
It exists. Samsung does it on the frame.
Yeah.
For $5 a month, rotate the various art. So it's already there.
A guy like you, Ron, who likes beautiful things and likes. So it's going to be embedded into our society. It's going to be part of our economy. Just talk to someone under 25. Talk about how they like to get services, how they like to think about that. Think about the value. We always think about the buy side. Buy side. And I'll end quickly. But think about the value to the sell side, meaning the issuers, right? So you can take something boring like rewards programs, like tokens, that kind of rewards programs that sit in your account, right? I only look at my JetBlue rewards when I book a ticket.
Yep.
And you can start to create a dynamic ecosystem around those rewards programs where you're engaging individuals on a daily basis. Now, they're not doing it for altruism. They're doing it because they'll collect our data. Right? The more they can get us to engage with these things, and that's what NFTs and digital tokens provide, is more individual engagement, the more data they'll collect from us. So it is here to stay. I don't think we will be subsumed by it. You don't have to worry. We'll still have books. Your daughter went to go work for HarperCollins. We talked about that too, right? There'll still be books in 25 years.
Yeah.
But we will engage with these things differently because they're smarter, they're more efficient, and companies will, quite frankly, force us. We will not have a choice. My mother, I'll end with this, I promise. My mother, after 20 years of holding out, just opened up an online banking account. She went from Chase to a credit. She fought it tooth and nail. I think she's 82 now. Finally, she was like, I can't take it anymore. I'm doing online banking. So we will have no choice. We will, like my mother, will be goaded into this, and you'll engage with tokens, and it's going to be fun, and everyone should just calm down about it.
Yeah. But I want to address it from a different perspective, from an investing perspective. The real chasm is retail versus institutional. And the reality is retail, from what I'm reading, and you know this a little bit better than I would, John, given the seats you sit in, retail has been taken advantage of. It's the Wild West. There are a lot of snake oil salespeople in the marketplace.
Yep.
And people don't really have an ability to distinguish the good from the bad. Institutional, they're long-term thinkers, or maybe some short-term thinkers as well. It's really a function of the framework of the law. And right now, I've literally spent the last 3 days reading up on legislation with regard to crypto. My instinct will be, I think it's going to be the SEC, CFTC, and other alphabet cities. They're going to be enforcing the rule versus an SRO, or versus, it can't stay the way it is. And the concern that the U.S. is going to be left in the dust if we regulate this, I don't have any fear of that even happening anytime soon. The SEC just took a position in a litigation that based on the number of nodes or the percentage of nodes in connection with Ether, I think it was like 48% of the nodes that are doing the analysis are in the United States, and the second closest country was Germany with either 19% or 20%. And so the SEC is saying by virtue of just where the calculations are being done, they can control it because we are the biggest population or location from where it's emanating from. And we are in a global economy to some greater degree. The world is moving towards that. I think it's a good thing because I think the economy then influences the politics, influences the population's mindset.
Yep.
Yeah, and listen, I think we could learn a lot from. You know what this sounds like to me? Think about just the conversations we've all heard in the last 10 years around just retail investing in things like hedge funds. Right, in things like venture capital and private equity funds, right? That was so. I agree with you on the retail versus institutional.
I just had
the advice I would give is stick to quality, right? Whether you're talking about, again, let's be honest, guys. How many hedge funds should really be out there? How many private equity funds should really be out there? Right, we have top 5%. Right. I chose to align my crypto exposure to a firm like Coinbase because they're super high quality. You want legal advice, you go to a guy like Ron. You want a good hedge fund, you stick to the pros. You want good data, you go to George and Convergence, right? So I think the story of the next 10 years is going to be we had this bubble of everything, and we have this excess of everything, including people. There's just too many jokers running around pretending they can do good work. And so I think we have, now bubbles are great. I like bubbles because bubbles produce productive infrastructure. It'd be great if we didn't need a bubble, but we're horrible investors as a species. We're capricious, we're emotional. So you have a bubble, and what's left over is really good infrastructure.
Yeah.
And I think the next 10-year story is flight to quality.
You know what's interesting? I just had this realization. So when I started Sadis and I got involved on television, I was often the one getting the call to defend the hedge fund industry. For whatever reason, there were a multitude of naysayers, and to me, I was like, look, the hedge fund industry as a whole can't be hated. I mean, you can, but it's just bad judgment. But
sure it can.
Crypto came out, funny enough.
Yeah.
I feel like there's very few people now throwing mud at the hedge fund industry because they're so busy throwing mud at the crypto space.
We love to eat our heroes, Ron. We love to eat our heroes. And don't get me wrong, hedge funds and crypto, they don't deserve it, but they led to this because both industries have the same problem. We choose the worst people to elevate up as our spokespeople. There are incredible people in hedge funds. There are people who are moral, ethical, humble, and we choose the clowns because the loudest voice clowns get to be propped up and be the de facto spokespeople.
Right.
And the industries have to do a better job of pushing forward people who are sober, thoughtful, innovative, exciting, but not jerks.
Right.
We have a no-jerk policy.
Loudest doesn't translate to best.
That's right.
I agree with that. All right, let's shift. Ron, I'm just going to ask you this question, and then we'll move to our final topic. Just quick view on what you think the SEC is focused on right now. What do you when you think about their agenda?
I mean, the story to some greater degree stays the same. If you're looking to their constituents that they're regulating on the asset management side, right? Because we say SEC, that's a really broad concept, but I'm going to focus on asset managers and wealth managers. They look to fraud. They look to misrepresentations with regard to performance. They look to disclosure of conflicts of interest, which is a big thing. There's a marketing rule that goes into effect November 4th of this year that's been kicked around for a year. All it is a codification to action letters. So it's really just creating an even playing field, and that's what's made the U.S. the powerhouse that it is in the securities industry. And when I was at the SEC, I was there when various other country regulators were coming in trying to sort of learn from and mimic what we were doing in the United States. By creating an even playing field, it makes everybody feel at least the likelihood of being robbed or misled is far less than it otherwise might be.
Yeah. I mean, listen, I've always thought from my vantage point, it's the most important thing they can do is protect the investor. Right, and that's right, and
yep.
I think that's job one. All right, let's finish up, and this has been terrific. I want to we're 60 days away from 2023. It's hard to believe, right? And this year went fast, and I don't know about you. I'm tired of talking about COVID and the pause, and ready for a fresh 2023. John, let's start with you. If I had to ask you, just hey, what's your view on 23? What do you think some of the major trends are going to be? Some of the big stories, some of the big topics. What do you want to see happen in 23?
Yeah. I mean, I think it's going to be rough. I think it's going to be a rough year. Again, as I said, the pessimists have the mic. We are tripping over ourselves to be more pessimistic. Those things tend to run their course. Trying to call a bottom is very, very difficult.
Yep.
So, but I think that zeitgeist has taken over, and it's going to carry over into the new year. It's going to carry over into Q1, Q2. The best thing to do, in my experience, is you try to out-yell them. It's like out-yelling the irrational bulls during the bull run, right? Who are you? Have fun staying poor. Everything's up. Blah 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 blah. Right? So they're going to control the narrative for some period of time. Generally, these things, the smartest people I know are looking at, let's say, 12 to 18 months.
Yeah.
That seems reasonable to me. So the smart thing to do is just shut up and build. Do your work, keep your head down.
Put your nose down, yeah.
Yeah, keep to Ron's point, keep cash, but then the metaphor carries over into your personal life. Keep emotional cash ready, right? Don't waste your time fighting. Don't waste your time arguing. Focus on your family. Things are going to be slower next year. Focus on what makes you happy. Get in shape. Keep liquid. Cut your expenses, and be ready for that cycle to shift back, or be ready to start Mad Maxing it in the desert. I'm gonna choose door number one. So I'm going to, make myself a little less visible, focus on quality. Ron and I are starting our own video podcast thing. George, you're going to be our first guest. We're happy to have you on. Focus on projects like that, and I'm going to be spending time with high-quality firms like Coinbase and high-quality people like Ron.
Yeah. Ron?
So the things that go through my mind, inflation. I knew it was coming, going back to my home construction. I locked in at a 30-year rate, 7/8. I just should have borrowed more money because that was a great hedge against inflation.
Yeah.
And that goes back to something John and I have been discussing with regard to mortgages. When the tide goes out, no one knows how far the tide's going out. I worry about the average person on the street, and they're really just having not laid proper ground with regard to the economics of their life, as with regard to over-leveraging on home acquisition and buying. I'm also concerned about the global political stability, Russia, Ukraine, China, Taiwan, a range of other issues. I naively had hoped we were living in a better world where people realize it's a global community and we're not tolerant of bad actors.
Yep.
I also am concerned that tied into this is employment. As the market gets shaky, the power is going to go back to the employer and away from the employee, balanced with this whole work from home, and it's not going away, and there's no consensus on how to deal with it, and I don't think there'll be a consensus on how to deal with it, but the work from home has increased costs, decreased efficiencies. I don't know about the two of you and anybody listening to this. Come Friday by 1 o'clock, if I haven't reached the person I want to reach, my concern is they start the weekend right after lunch because of the work from home model.
Yeah.
So it's having a permeative effect and a lack of accountability actually in some of the things I'm doing in my personal life, which is causing me concern.
Yeah. No, it's but I always think one good overcomes evil, right? When we think about the bad actors in the world, and I find I worry about my kids at this age, right? 28, 22. It's hard to believe that some of what's going on in this world right now. Like I would think we were a much more civilized, global community, right? And I'm with you, John. I think we will cycle out of this very tough period, but I think it's going to be a while.
But George, as bad as things are, let's end with optimistic tone.
Yeah.
As bad as I have two young daughters, 9 and 5. I hear you, man. I hear you. I'd still, with everything going on, I'd rather them be born now than in 1920, right? I'd rather them have the right to vote.
Yeah.
So I just, you're right, and I'm not minimizing anyone's pain and frustration about where the world is, but we do have to remember that if you could roll the dice again and be born any other time in human history, you kind of be nuts to pick any other time but
That's
now.
Right. Nothing but opportunity, right? And I think we've got a good, we've got our hands around what we've got to solve, right? And I think we will, right? So I'm very bullish long term about all of this, and I think it will sort itself out. And but it's incredible, some of these current growing pains to me.
George, to play the parent card, there's a few things. If we look at our life and the development of technology, we have more contact but less connection. And looking at how I was as a child versus as an adult and at this stage of my life, and my role as a parent is to reinforce the optimism with my children, because at times I feel like they and friends of theirs feel very lost and swept away and overwhelmed by everything going on. And yes, they have more contact but less connection.
It's not as deep, right? And to your point, right? And like I think about, and you mentioned this earlier, John. I know we're kind of straying here, but people think research is asking 3 questions on Google search and they've done their research, and they're not deep, right? And that's what we try to talk about with our kids. It's about the right way to do things and not to get caught up in some of this easy peasy stuff, because it's not the right way to do things. And I think the connectivity.
Again, I want to end on a positive note. I hear what Ron's saying. I hear what you're saying. My 9-year-old daughter also gets to video chat and play games with her 9-year-old cousin in Bogota, Colombia, for free, effectively.
Yeah.
And so they're engaging in a way, and they're building a relationship in a way that, quite frankly, without this technology, they would see each other once a year. They probably have no relationship. So again, not minimizing what you're saying, but I'm optimistic. I see incredible things. This is my last comment for me. When I was growing up, I'm Italian. My parents were born in Italy. I would get punished if I spoke Italian, because they were like, tutto americano, you have to be American, no accent. You're a bad parent if your kid doesn't speak 3 languages now. I think that's a good thing, right? So I am
My father was
optimistic.
born in Austria, and my mother was born in Israel, so like you, we're both first-generation Americans. My parents spoke 6 languages at home. Now, English was always the primary language, but I learned multiple languages because we spoke them all, and it was like Spanglish. When friends came over to my house, I don't know if you have this experience because we've never spoken about it despite our friendship.
Yeah.
My parents would break in other languages, and my friends would get irritated as could be because they were left out of the conversation. But look, the 3 of us agree there's opportunity. We have reason to be optimistic. We live in a dynamic world. There will always be some bad. But on a relative basis, I feel like there's far more good.
I agree.
Like I think about what's going on in Iran, the fact that I'm seeing videos and there's so many people taking a position for human rights.
Unheard of, right?
It's
I agree.
unheard of previously. And so, yeah, there are bad people out there, but those people, in my mind, have a limited timeline. And it's just a matter of time. I feel like there's fewer bad people than there were in my parents' generation and my grandparents' generation.
Yeah.
They're amplified, though. They're amplified. They're the minority.
Well,
they're just an amplified minority.
Right. All right. Well, listen,
I hear you.
gentlemen.
All right, guys.
This was terrific. I am really thankful for you spending the time with us, and enjoyed talking to you guys. So thank you for being part of this today.
Thanks for inviting us, George.
Having you on the vlog.
All right. Look forward to it.
By the way, if anybody listening has ideas, we're kicking around ideas like pizza bagel.
For the name of our blog, George, you have to give us some advice.
There's so many different directions we can go.
Yeah, right. Well, listen, I'll give you some thoughts. Right, we've stayed the course well here, and I think it's been because we've always try to have interesting people on who have an opinion, and we try to get at some topics that people care about. Right, so. But listen, a real pleasure, and thank you both.
Take care, guys.
Pleasure is ours. Thank you.
All the best.
Thank you both. So I want to thank, I want to thank John and Ron again, and let me finish just as I always do each month with a few comments around our league tables and market share. And what I like to talk about is just the distribution of business, right? Where that business is really going relative to growth. So I'll start with fund administrators, right? We saw assets over the last year down about 5%, and the largest 5 admins kind of reflected that. They were down around 5.5%. But interestingly enough, admins 6 to 10 grew at about 6%, while the market was down 5 on the asset front, and 11 to 25 grew at about 11%. So twice, twice the growth of 6 to 10. But where a trend we saw that's a little different is admins 26 plus all went down about on average about 17%. So really, that mid-tier admin 6 to 10 is the only one who benefited from asset growth in the last year. On the auditor front, that distribution is pretty interesting. Also, we saw the big 4 grow on the asset front about 11%. But we saw auditors 5 to 10 grow at 22%, and we saw auditors 11 to 25 grow at 46%. So that is just a statistic we haven't seen, where it's very interesting, and the numbers are significant in terms of people pushing audit work down market quite a bit. On the custodian front, interesting, right? We saw the top 10 custodians down about 2% in terms of asset growth. Custodians 11 to 25 up about 5%. But custodians 26 plus. Now remember, there's 1,400 custodians, up about 20%. So again, a little bit of a down market trend. And then lastly, on the prime broker front, and we do our prime broker market share by looking at funds. So funds grew about 11% over the last year. Prime brokers 1 to 10 grew at around 4.5%. Prime brokers 11 to 25 grew at around 7.3%, and all other primes, and there's about 300 primes, grew at about 11%. So 1 to 10 kind of holding their own, but again, we're seeing some real growth at 11 and beyond. So interesting time. I think there's a flight to quality. I think people are challenging pricing. I think people are diversifying. So listen, I want to thank you all today. I thought this was a very entertaining podcast with Ron and John, and I want to thank you for spending time with Convergence this month. Again, I'm George Evans, and we will see you. Have a great week, and we will see you in November for episode number 21. Thank you.